Everyone thinks the biggest risk to the US economy is something flashy, AI hype, China tensions, or political drama. But the real risk? It's something so boring that almost nobody is paying attention. And ironically, that's exactly what makes it dangerous. If you've been wondering why mortgage rates aren't falling, why markets suddenly panic out of nowhere, or why the Federal Reserve can talk about rate cuts but money still feels tight, then you're looking in the wrong place. The real story doesn't begin in Washington. It begins in Japan. To understand this, we need to go back to the early 1990s. Japan's massive economic bubble burst, real estate crashed, stocks collapsed, and the country entered what became known as the lost decade. Growth disappeared, inflation vanished, and wages barely moved. It was like the entire economy just froze. So the Bank of Japan did what central banks do when they run out of options. They slashed interest rates to zero, then below zero, and eventually introduced something called yield curve control, basically forcing long-term interest rates to stay extremely low no matter what. Now, here's where it gets interesting. For decades, Japanese government bonds paid almost nothing, so Japanese investors, banks, pension funds, insurance companies, faced a simple choice: accept zero returns or invest overseas, and they chose to go global. This kicked off one of the biggest financial flows in modern history. Japan became the world's largest creditor nation and one of the biggest buyers of US treasuries. In simple terms, Japan became a massive source of global money, and this gave birth to something called the yen carry trade. Here's how it worked. Investors would borrow money in Japanese yen at near zero interest rates, convert it into dollars, and invest in higher-yielding assets like US bonds, stocks, real estate, even emerging markets. Because borrowing was so cheap, this became an easy way to make money. Over time, this trade grew to trillions of dollars. It was like global markets were running on cheap Japanese funding. But here's the catch. This entire system depended on one assumption: Japanese interest rates would stay near zero forever. And in 2024, that assumption broke. The Bank of Japan started raising rates for the first time in years and began stepping away from its ultra-loose policy. Suddenly, borrowing in yen wasn't so cheap anymore. Currency hedging became expensive, and the once easy money trade stopped working. That's when things started to shift. When the math changed, the money started moving. Instead of flowing out of Japan, capital began flowing back in. This process, called repatriation, is a big deal because it means less money is supporting global markets. And this is where the real problem begins. For decades, Japan wasn't just buying US debt, it was consistently soaking up massive amounts of it. But if that demand slows, someone else has to step in. And if they don't, yields have to rise to attract buyers. As Ray Dalio explains, the bond market is the backbone of everything. It determines how assets are valued, how money flows, and how economies function. So when long-term bond yields rise, it doesn't just affect bonds, it hits everything. Stock valuations start to compress because future profits are discounted more heavily. Mortgage rates stay high because they're tied to long-term yields. Housing becomes less affordable. Companies face higher borrowing costs. And suddenly, economic growth starts to slow. This is why the situation is so misunderstood. Everyone is focused on the Fed and short-term rates, but the real action is happening in long-term rates, driven by global supply and demand. And if a major buyer like Japan steps back, it creates a ripple effect on the entire financial system. The uncomfortable truth is this: for the last 30 years, the global economy has quietly relied on cheap Japanese money, and now that source is drying up. This isn't loud. It doesn't make headlines. It's not trending on social media, but it matters because liquidity, the easy flow of money, is what keeps markets alive. And when liquidity tightens, everything changes. Stocks, housing, credit, nothing is untouched. The biggest risks in markets aren't always the obvious ones. They're the silent shifts happening in the background. And right now, one of those shifts is coming from Japan. Thanks for watching. Do not forget to like, subscribe, share. Stay smart.